Okay, good morning, good afternoon, everyone. Just wanted to welcome you to the Founders First webinar, the power of partnering with a revenue-based funder. We are hosting this in conjunction with the California Southern SBDC, and I want to introduce our, our West Coast Southern California Business Development Manager, Oscar Franco, to take it away and just ensure that you hold all your questions until the end. Thank you.
Perfect. Tracy, appreciate that. And once again, to all of you joining us today, we really appreciate taking some time out of your day to join for this webinar, The Power of Partnering with a Revenue-Based Funder in collaboration with the California SBDC. Take it away.
Oscar, I think you kind of broke down for about the last 15 seconds.
Can you guys hear me?
Okay, here we are. There you are.
Oh, perfect. So appreciate that. So before we get started, so my name is Oscar Franco. I'm the West Coast Southern California Business Development Manager here at the Founders First. And also joining today is entrepreneur, founder, and CEO of Founders First Capital Partner, Kim Folsom. And also joining me today is Juan Carlos Hernandez, the CEO of the California Southern Small Business Development Corporation. Once again, Juan Carlos, we appreciate all of your help in helping us set up this webinar. And also, I was sharing with you earlier today that here at this webinar is not only CDFI partners, but also some of our local partners here for Founders First in the SoCal region. So if you don't mind sharing a little bit more of the California Southern Small Business Development Corporation, and also share a little bit more about the current partnership that we have here with Founders First Capital Partners.
Of course. Thank you, Oscar. Good morning, everyone. Welcome. It's a pleasure to be here. It's a pleasure to have all of you to join us. A couple of things with regards to the California Southern Small Business Development Corporation. We actually manage a state guaranteed loan product that the state of California offers in order to provide up to between 80% guarantee on small business lending for entrepreneurs and small businesses located in the state of California. In some instances, we actually have been very successful at also managing a disaster loan program that allows for up to 95% guarantee on these small businesses for access to capital. We work heavily with many of our CDFI partners, which are mission-driven lenders, as well as many of the community banks and state charter banks located throughout the state of California. I'm actually very proud to have a very strong working relationship with Founders First and with Kim Folsom directly. Kim is actually on our board of directors, so thank you, Kim, for that. But one of the highlights about working with Founders First is, as a banker of over 30 years, one of the challenges that we have is what happens with some of our small businesses when they don't qualify for some from conventional financing, or even partially for financing with some of our mission-driven lenders. So we always want to make sure that we have these additional partners that can take advantage, or that they can actually take care of our clients, and our clients can take advantage of their products in order to continue their growth trajectory, and then be able to come back to us for those particular loans. So with that, California Southern has been doing this it's going to be almost 35 years. And we're very proud to be able to support many of our lenders, as well as to establish that capital for the small businesses. And with that, I'll just kind of hand it over to Oscar and Kim.
Perfect. Thank you for that. And I think this is a perfect segue to where we are about to chat during this webinar. So Tracy, can you move on to the next slide? So this is our agenda for today. So as you can tell, we're going to cover a lot of topics. Primarily, we're going to focus around revenue-based financing. How does it work? What it is. We're also going to talk a little bit more about other resources that we have here at Founders First, especially on our nonprofit side, which is Founders First CDC. But before I get started, I think it's very important to share a little bit more of who we are, and more importantly, why did we start Founders First. So our mission here at Founders First is to level the playing field for underserved businesses, meaning we have a very big focus on businesses run by women, minorities, veterans, LGBTQIA+, and those who are doing business in a low to moderate income area. And our hypothesis behind Founders First is that these businesses have been dramatically underrepresented in the ranks of business leadership, and our goal is to change that and to change that immediately. So how do we do it? We basically do three main things here at Founders First. One is that we have education and mentorship programs through our Accelerator programs. It is a great opportunity to provide them with resources and financial literacy for entrepreneurs to continue to grow their business and basically take their business to the next level. We also provide revenue-based financing through our revenue-based fund that we're going to cover a little bit later today in this presentation. And we also provide grants. We've been very fortunate to have amazing backers and sponsors during the previous years that we are now able to provide grant money, free money, paired with free tuition to our accelerator programs for founders, not only here in the Southern California, but also nationwide. And I think this is a great opportunity for us to ask, if you happen to know any businesses that might be in business for a while, that might be struggling, that maybe they need to add additional revenue into their business model, or they need to innovate, or there's a lot of challenges that companies are facing. Our programs are a great fit for that. And also, if you happen to know any businesses that maybe it's fundraising, but it's not quite there yet, it is not ready for it, I would say the main goal of our programs is to make sure that at the end of all of our programs, the companies are funding ready. So they have a pitch deck, they have their financials in order. So that's, I would say, that one of the biggest things that companies get out of our programs. And our numbers speak for themselves. So if you don't mind, Tracy, moving to the next slide. So combining our revenue-based fund and our accelerator programs, we have served over 500 companies. We have been able to help them increase revenues, increase profits, adding recurring revenue streams into their business model, adding new key hires into their companies, and also around 53% of the companies that go through our programs end up fundraising or end up getting some money to continue to grow their business, whether it's to our revenue-based fund or with working with other amazing partners nationwide. So I think this is going to be a great second ask for us, for you. If you happen to want to continue to learn or learn more about some of the companies that we work here at Founders First, this could be a great start. Going into the portfolio of the companies that go into our program, and maybe get some referrals out of that. So I think that could also be a great opportunity. So if we can move over. So let's get started a little bit. Let's go into the current landscape that businesses have in order to get access to funding. So if you don't mind. So I'm sure all of you are aware of this, but this is the current landscape of fundraising that small businesses have. So on the left side, we have the traditional money, we have the banks. So it's, I would say, the cheapest money out there. But the truth is, none of the companies, as Juan Carlos was saying, qualify for that, especially those that are at a very early stage. So I think even though it's a great opportunity, if there's a business out there to have access to this sort of money, we always recommend to go that route. I think that's probably the cheapest alternative that is out there. Then on the right, we have MCA loans, which are very easy to get, but as we all know, they are very expensive. 30s, 40s, 50% interest rates. And sometimes companies end up stacking a lot of those into their financials, and eventually at the end, it's detrimental to their growth. Now on the right side, we have the equity partners. So this could be a great alternative. If you're a high-tech company, high growth, they have a very clear exit strategy into your business model. Equity fundraising is a great alternative for you, but pretty much similar to banks, it's not for everyone. And especially it's not for the type of companies that we support here at Founders First. So that's why we sort of put ourselves in the middle in here. So it's, even though we provide debt, we do have a vested interest in the company's growth. So moving on. So revenue-based financing, what is revenue-based financing? So revenue-based financing is a great alternative for companies out there that do not necessarily qualify for traditional banking, but they are in need of some capital growth. Some people out there sort of confuse revenue-based financing with MCAs, asset-based lending, factoring. It's to be honest, it's very different to that. So our model is, think about it as a term loan, but instead of having a fixed payment on a monthly basis, we take a percentage of the revenue on a monthly basis. So for a company that has maybe some seasonality in their business model, on on the slower month, they're going to pay less of their loan. And in comparison to a stronger month, they're going to pay a little bit more. So some of the other benefits is there's no financial covenants, non-dilutive. We don't take any equity out of the companies that we end up providing some growth capital. No personal collateral, nothing related to that. We don't ask for a confessional judgment or anything related to that. And no credit check as well, because we do understand the companies that we serve. We understand that in the beginning, especially at an early growth stage, companies are bootstrapping. Maybe they max out their credit cards. So we only focus on companies' performance, not necessarily on their personal financials. So moving on. So with that, I would like to introduce you to Kim Folsom, our CEO and founder of Founders First Capital Partners, who is going to talk a little bit more in depth about our revenue-based fund. So Kim, take it away.
I'm delighted to join you all today. Thanks so much for Oscar for organizing this, and Juan Carlos, of course, your support. A little fun fact. So some of you may know that Founders First is my 7th company, but my very first company in the mid-90s in the crazy .com era, I got my very first external funding from Cal Southern. They were the first company that helped me get connected to a funder that took a leap of faith on me as a early founder of my first company. And they actually provided me with 6 figures of capital that helped me to hire some of my first employees. So I have a very, very solid support and perspective with regards to Cal Southern and the work they do with enabling underserved founders. And my journey, you know, as a founder, I always think of myself as a small business founder. I took capital from every source imaginable. And it was my performance with my first funding through Cal Southern that helped me attract other funders. I've taken funding from CDFIs, some of them that are on this call, as well as, you know, the vast majority that I raised because I ran tech companies was from VCs. But, you know, having to do it all again, I wish I didn't have to give up as much to get capital, grow my business. And that's why I am a big proponent of working with companies like those that are on this call, as well as the funding model that we use. So I'm going to share with you a little bit about why revenue-based funding works. This is specifically about how the model works, but you know, some people think of revenue-based financing as it's a new thing. And actually in a couple of industries, one of them in the entertainment industry, revenue-based financing has been used for, you know, hundreds of years. Basically, you know, there's based on the strength and predictability of future revenue streams, there's an allocation of funding. And the investment is based on the strength of those revenue streams. It's not based on strictly the founders or business owners' financial profile, nor their personal or assets. So it provides them with growth capital because they have a strength of predictable revenues. And generally, these companies are asset light, meaning, you know, they may not have a home or a building or something to pledge against their loan as a secondary or tertiary source of replacement capital, but they do have a good business that's generating a predictability of revenue. And generally, they're B2B companies. So with that as a baseline, you know, the way revenue-based financing works, and specifically our method of this, is we will provide funding of up to $2 million of growth capital, as you know, to an entity. That's overall for the life. On an individual transaction today, we'll go up to $600,000. It's paid back not based on a fixed payment that they have to pay regardless of how their business is performing, but it's more flexible. They take a royalty percentage that ranges from 2 to 5% of their monthly net cash receipts. And I'm going to show you an example of how that works. But first and foremost, they pay it back to agreed upon cap. So that cap can range anywhere from 1.2 to 1.5. And again, this is our method of doing this. So there's not a, specific fixed interest rate, if you will. It's more they pay back through this royalty payment on a monthly basis till that cap is reached. And once that cap, repayment cap is reached, then there's not any further payments that are made. The benefit to the borrower is that the interests are aligned because we as Founders First and other revenue-based lenders are incented to help the business grow their revenues such that they are able to make their payments. And we work with existing lenders. If they happen to have an SBA loan or something of that type, we will subordinate to that loan. Our goal is to help them get through the point where there's a much more predictability and stability of their revenues such that they could graduate onto many of those commercial lending programs. That's where probably 85% of where our companies grow to, where they're much more stable there, and they generally get there north of 5-10 million in revenue, especially since they're asset light businesses. If you can advance to the next slide. As Oscar mentioned, there's not very limited financial covenants with regards to this. The payments are based on their actually company's revenue performance. There's, unlike equity, there's not a loss of control. So there's not a board seat requirement. So there's no replacement of management. Again, the interests are aligned because as the company grows, then their royalty payment, helps pay back that cap. There's no pledge of specific assets. There is advice. We provide both support post-funding and advisory services. Think of it as a co-pilot to help them grow. And the founders retain the value. There is, think of it unlike equity where they have to have a liquidity event in order to pay back the investors. With the monthly, royalty driven payments, they have that liquidity component associated with that. So the business owner retains the ownership and they're not giving up equity and, an ownership in the company to get access to 6 figures of capital. Just from an example, the 2 million up to that amount, and we do follow on, so it may be an initial investment of 500,000 or 600,000, and then based on performance, we will do follow-ons. Generally, from looking at the size range, the size of the capital can range anywhere from 10 to 30% of the annualized revenues associated with this. Again, there's no set interest rate, and the monthly payment is tied to the, a royalty percentage of the monthly revenues. And I'll show what that looks like. And as I said, we can come behind a SBA or bank loan to, help with the capital stack. And then we also many times help them refinance out of less favorable debt. Again, if you think of how movies or TV shows or Broadway plays are financed, it's using a revenue-based arrangement such that they get, access to a certain allocation of capital, and then they pay it back on a royalty stream. Many times, because of the risk associated with, those types of arrangements, it's maybe a perpetual royalty payment. With us, there's a specific cap. So you can look at this example. If somebody has $1 million in annual revenues, they can get access, in this particular example, 20% of principal. They pay that back generally over a 3-year period. As part of our underwriting process, we look at their, the stickiness of their revenues, the gross margin, and the type of business models such that, from a sizing standpoint, is it the 10 to 15% range on the sizing, and then looking at from a royalty amount such that they're able to pay back this over that period of time. The repayment cap in this particular example is 1.3. So while we provided them with $200,000, they'll pay us back 260%, and there's no penalty if it's paid off early. There's not a lien placed on their personal assets, and we don't look at the person's FICO score to discern whether they get this access to this capital. Now, you can imagine all of you guys on this call are in the credit business. This is a bit riskier type of a transaction because we don't take this secondary or tertiary pledge of their personal assets. But the reality is, 80% of businesses are those businesses that are not trying to be the next, unicorn businesses. There are what we call the zebra businesses that, are great, employers, and, they need that, 6 figures of capitals to, hire people, invest in marketing, improve their capacity. And so this is a good source to help them on their journey to becoming better credits to, stronger, more commercial financing. Next slide, please. So this is an example of, a company that may be, in a revenue-based financing situation. As far as the items that we need for them to underwrite, first and foremost, we, prefer that they can provide 2 years worth of financial statements organized by month. We have been able to accept a year to go through and do this, but generally they are 2 years of financial statements. We also need a list of their revenue by customer so we can understand, again, the strength of this is based on their revenues, a debt schedule so we can see whatever their prior debts obligations so that we can understand how they would debt service the net new funding from us, and then ideally projections. It may take us about 30 days to underwrite and fund this transaction if they can provide this information. And, we really strive to make it very easy to move deals across the finish line. So this is an example of how we actually service this. Example, company has $122,000, rounded up $123,000 in net cash receipts. This is, we define cash receipts as those gross cash receipts as those revenues that come from, customers doing business. They may have other cash that comes in the door, like grant proceeds or contests. They may have won a pitch competition, or maybe some, refund of its administrative fees. So if they were looking at them from an overall cash basis, on a monthly cash basis, they may had cash that came in for the month of $154,000. But we back out the non-business receipts cash, which gets to the net cash receipts of about $122,970. And then we take our royalty payment, in this example, 5%, based on those net cash receipts, and that's what's applied to that cap to pay down that loan. Next. So I'm going to share with you a case study because people always often ask, well, what type of business does this work for? So I'm going to share with you an example of a company. So this is a company that was a service-based, business. They provided control management compliance services in what they call control master services for pharmaceutical life science companies that provided either pharmaceutical device compliance. And, because they were largely a service-based business, a B2B service-based business, they weren't a great target for, traditional VC monies, VC funding or equity funders. They needed capital that was, north of $250,000. Ideally, they wanted $500,000 in funding. So, this is an asset light business, so they didn't have to own a building to pledge against this. And, honestly, they had some, business financial challenges. So we were able to provide them with access to $500,000 in funding. And at the time when she came to us, she had about $2 million in annual revenues. And with that $500,000, she was able to grow her business in, gosh, I want to say about 12 months, 1.5%. And that also landed her on the Inc. 5000 for 2001. And she's become such a great inspirational role model to other BIPOC founder-led businesses. She's a certified DBE and MBE business. And so I'm going to turn it back over to Oscar to talk about how, CDFI partners and other community lenders can partner with Founders First.
Perfect. Thank you, Kim. So next slide, please. Perfect, that one. So there's numerous ways that you can support us here at Founders, whether it's a Founders First CDC, our sister company, or Founders First Capital Partners, our lending company. So I would say number one is assist. So if you happen to know any businesses that is currently looking for funding, maybe you have explored, maybe you have funded that company in the past and they're looking for additional funding, we could be a great option for those companies. So any referrals that you have your way, feel free to send them my way. We'll make sure to take care of those for you. Partner, as I shared previously, some of the companies, and I'm sure it's going to be one of your questions, may not be a good fit for what we do here at Founders First. So we are always working with lending partners, whether it's lending or equity partners nationally. That might be a good fit for some of the companies that graduate from our programs. So I will be interested in learning more about your offerings, more about your specifically whether you provide debt or equity solutions, and hopefully add you guys into our list of potential funders as well. The sponsors, so for our nonprofit Founders First CDC, we're always looking for sponsors, whether it's for upcoming events or to continue to provide grant money to the companies that want to go into our accelerator programs. So we're always welcome for that as well. Participate, and this could be a very easy way to engage with us here at Founders First. We do have pitch events at the end of every accelerator program. So if you can volunteer, believe me, I'm going to reach out to you eventually. If you can go into one of our programs, be a judge, be a speaker, or even attend as an attendee to the event, you will get an opportunity to meet wonderful entrepreneurs doing amazing things, not only from the SoCal region, but also nationwide. And I will say the last thing will be promoted. So if you happen to know any business that might be a good fit for our accelerator programs, also please send them my way. We also offer grants, and we're going to cover in a couple more slides. We're going to talk a little bit more about the grants, but it could be a great opportunity for your clients to get access to free money as well as free tuitions to our accelerator program. So in the past, Accessity, Acciona Opportunity Fund, which I know they're here, have been great supporters of our grants, and we would love to have more partners as well. So yeah, next slide, please. So I'm going to talk a little bit more about our accelerator programs. I promise I'm going to be brief. I'm sure you have a lot of questions, and I would really want to open it to questions. Rosalinda, hi Rosalinda, I know you're here. Appreciate you being here. So Founders First has two entities, right? So Founders First Capital Partner, which is the one that provides the loans, but we also have our nonprofit side, which is Founders First CDC, the one that runs the accelerator programs. Next slide, please. So we have three different accelerator programs here at Founders First. We have our entry-level program, which is Challenge, our intermediate program, which is called Bootcamp, and our advanced program, which is FastPath. As you can tell, all of them are basically targeted for different growth stages, for companies. So just to give you an idea, maybe on Challenge, which is for companies that are between 50 up to 250K in annual revenue, we focus a little bit more about finding your unique value proposition, your MTP as a company, adding your recurring revenue stream to your business models. In comparison to FastPath, we'll be focused on 3 to 5 year growth plans, hiring, recruiting top talent into your company. So all of the syllabus are completely tailored to help different growth stages of the companies that we serve. And we also have a program for fifth graders where we try to basically pursue them into entrepreneurship at a very early age. And we have done that twice here in the SoCal region, and we are more than happy to continue to look for partners for that program as well. Next slide, please. And lastly, our grants. So we do have national and regional grants at Founders First CDC. The first one that I want to talk about, which is our biggest grant, is the Job Creators Quest grant, which is we have a total of $100,000 that we are basically looking for 30 companies to continue to provide them with some funding to continue to grow their business, as well as a 100% free tuition to join one of our accelerator programs. This could be one of the easiest way to partner with us, our Founders First. Our upcoming program, it's already up in our website. We're going to provide you with that information at the end of this webinar. Feel free to share it with your network, with your partners, anything that might be a good fit to apply for the grant. We are more than welcome for that. So the grant is already open for pre-registration, and the full application goes live on October 18th. So be on the lookout for that. And we also have national grants, which is our Kitty Fund and Steve Fund. So Kitty Fund is for mompreneurs. It's a microloan. We look for 50 companies and we provide them with $500 in grants, which is obviously we know it's a microloan, but it's just a huge way to get them started, especially those at a very early stage. And also we have the Steve Fund, which is also a national grant for veterans, also a microloan, and it's a perfect opportunity to get access to some money, some loans to continue to invest in their companies. Obviously, we're going to provide you with all this information at the end of this webinar, and we hope that we look forward for your support promoting our grants. And so with that, we would love to open it up for questions. Any questions you might have, whether it's related to our programs or grants or specifically our revenue-based fund.
Hey, Oscar, there was a question from Roberto Valdez that was on the chat room. I don't know if you would like to address that.
Yeah, I was just going to say that one. So are you a CDFI? Do you originate and collect on your own notes, or do you participate with other lenders and other broker requests?
So I'll take that one. We are not organized as a CDFI. We are a certified financial lender, but we do collaborate with other lenders, brokers, CDFIs. We've sent many of the companies that have come through our both our challenge and bootcamp programs to CDFIs, and they successfully got funded because they had, needed to strengthen their business model or improve their business financial health to have to be fund ready. But we are Founders First Capital Partners is a for-profit corporation that's a certified financial lender.
And then there was also a follow-up question in there of what's your outlook or projections on interest rates range with the current environment, high inflation, and the percentages going up?
I think that we position where we are to be in the middle of as Oscar mentioned, that the small business SBA related transactions are probably the most inexpensive sources of capital, but our ranges tend to be low teens to to around 20, I would say in the very, very low 20% range as far as the source of capital. Because again, we don't require that our borrowers pledge their personal assets to gain access to capital.
Okay, and then what's the criteria for revenue-based financing versus SBA funding?
So I guess a couple things. One, we do look at the character of the borrowers, but the personal credit as well as collateral pledge requirement, we don't have that as a requirement like SBA, the traditional SBA transactions require.
And then what's a standard amount of funding that you provide?
The average transaction is about $250,000. But, from a range standpoint, each transaction can go as low as 50,000 up to 600,000. And then like an equity financer, we will do follow-ons. So we will do follow-ons to other transaction at, performance-based. So, that example that we shared with you on onshore technologies, we've been able, based on their performance, they're on the path of probably maybe by the end of this year doing $5 million, which, they came to us at 2 million. And so we've been able to do follow-on funding to them, up to, having them approach the 7 figures of capital market. And that's allowed them to grow, 2.5 times in 24 months that they wouldn't otherwise go through and do this.
If you are, I don't know if this is the right word, pari passu.
Oh, it's basically, that means that we are on par with other lenders, but we're willing to be subordinate to SBA funders because of the tighter level of scrutiny that you guys make with regards to your loans. And then we also will pay off, some very high, Oscar talked a little bit about, some of our borrowers, as you all know, get involved with taking some MCA or very high interest rate money. We are, more than willing to pay off those, higher, help them with refinancing those.
Okay, so if you're pari passu with another lender, how does that work when you're keying repayment off of revenues while the other lender's keying repayment off of profit?
We do coordination of that. We've done some deals in coordination with other lenders, and as part of looking at the debt service, we take those things into consideration as part of approval through our investment committee.
And then are there any referral benefits?
Yes, there are. We provide a referral fee of up to 1% for deals referred to us. So happy to share those. We have a referral agreement in place as well that we could be happy to share.
And then kind of a follow-up to that, what's the best way to send through deals?
Connect with Oscar.
Connect with me, I would say, absolutely. So I believe at the end of this presentation, we're also sending our contact information. So feel free to send any potential leads, whether it's for our RBF or for our programs our way. And nothing, as I mentioned before, also, if you want to promote the grants to your clients, that could also be a huge help for what we do here at Founders First. So I'm basically your main contact here at Founders First.
And I would also add that these grants are, non-dilutive, they're, free source of capital to help them. So they're not loans. They are, capital for them to use specifically. Our request is you're looking to improve your business so that you can, increase your, team so that you're in a position to hire 1 or 2 people generally on an annualized basis. We've had people use those, grant dollars to do anything for advertise to hire new people, use them as, hiring bonuses, because this is a really tough recruitment framework. They've used them to pay for fees, to support going to a conference, doing sponsorship. So they've used it for marketing projects. So just a variety of things that they're able to use those grant dollars for to help them advance their business.
And I think this is the last question that came through. What's the source of capital to fund the deals that you're doing?
So we are very focused on helping these diverse-led businesses to become better job creators, because, really being able to help them being a larger, diverse, being employers for a larger, diverse workforce. And so with that mandate, and we also focus on over 75% of the companies that we fund are, in that diverse bucket of, women, people of color, military veterans, LGBTQ, or in LMI areas. And with that mandate, we've been able to attract funding from the top diverse, top nonprofit foundations from Rockefeller, MacArthur, Kauffman, Kellogg, and I know I'm missing some others, but I invite you to check out our website so you can get a chance to see who some of our funders are. But many of these, top national foundations have a mandate to increase, the social, economic gap for access to funding. And so we are grateful to have them as our partners to help fund these companies.
So we had a couple more questions come through related to the grant. So what is the deadline for the grant that you mentioned, Oscar?
Yeah, so the deadline to apply is November 15th. Right now, the grant is live for pre-registrations, so feel free to share it. People can already start submitting their application, but the deadline, the final day to apply is November 15th. And I think we have another question. Can they apply for a grant without being a revenue-based financing? Absolutely, 100%. So as I mentioned before, the grants are run by our Accelerator program. So they're not related to our revenue-based fund. Obviously, the idea behind it is, as Kim was saying, is to provide these companies with free money that basically that we are not asking the use of funds. Is for them to invest. The only requirement is that they invested in their business. So yes, there's no requirement for them to be a revenue-based finance client.
Okay, I think that was all the questions that we received. As we said, we're going to be sending out these slides and a copy of the recording to everyone that has registered and attended, and for those that happen to miss today's webinar.
I want to thank everyone again for your time. I know you're all super busy. Thank you so much, Juan Carlos. This is such a amazing full circle moment for me. As as I shared, it was Cal Southern that was my first funder. So I appreciate your continued support and being able to help other business owners, achieve growth and success with their business. So thank you again, and thanks to everyone who's been able to take the time to join us and hear about how we look to partner with more CDFIs and community lenders.
Perfect. And just on a last note, you're going to receive some follow-up information. You're going to receive the recording and some additional information of our fund and our upcoming grants. And also in there, there's going to be my Calendly link in there. I would love to meet with all of you, learn more about your offerings, and hopefully making this a start of a great long-lasting partner relationship with all of you. So thank you to all of you for joining.
Thank you, everyone.